All right. It is Friday. We're live. Let's make sure we got all the socials here. Yes, we do. All right. Let's get this party started. Pull my thing here. Hello, Smart Money 2 podcast listeners. Welcome to the show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with my good friend Doug Hagren. Hey, Doug.
Hey, Kirk. Hey, Kirk. Happy Friday. How are you
Hap-
doing today?
Happy Friday. I'm doing great. Once again, I got my ice bath going. I got my cold showers, and I guess you could say I'm kind of a wuss because it's the summer and it's nice out. But I'll tell you, it is a pure shot of adrenaline going in that thing. I feel good all day, so I'm loving it. And we'll see what happens when I get a Minnesota winter this summer and I decide like, yeah, it might be a little too cold for that, but we're not there yet. So it's been fun. It's been a fun journey. So all those you listeners who haven't done it, highly recommend it. It is very invigorating, and I hear it's got a lot of great health benefits. I've actually been researching it more. 11 minutes a week is all you need.
So,
Cold.
do you do ice? Are you going to do ice baths when it's like 15 degrees in Massachusetts? That's one thing. I mean, it's fine and dandy when it's 80 degrees there to jump in an ice bath. But how are you going to handle going from ice to ice? Are you just going to put that thing away and go out and lay in the snow?
Yeah, there is an element of that, Doug. If you see me walking around my yard bare feet with like just shorts on and no shirt, you'll know that it's actually warmer than jumping in cold water at 15 degrees. It's actually a good question, and so it's interesting. So I've been doing some research, and just for myself, there isn't an adaptation process. And I know we're not talking about money yet, but this should make you smarter and healthier, so then you can live longer and enjoy your money. So there's an adaptive process which I've known about for a while, which is when you start the process of like cold showers, which is the best first step. You start small, 30 seconds, do as cold as you can. Tomorrow, do as cold as you can, 30 seconds. Next week, bump it up to a minute, as cold as you can for a minute. You just keep doing that, and your body adapts to colder and colder temperatures, and then it becomes less and less uncomfortable. Now, the downside to that is it's a lot harder to get into cold showers that have the beneficial effect that you need because you're more adapted to it. Um, However, my understanding from listening to Huberman's podcast, which is great. He interviewed Susan Soberg, who is, I guess, an expert in this area and has some great research on this. She suggests there's 11 minutes a week is all you need of cold exposure. And the cold exposure has to be something that's going to, like, I'm just going to say something, but I don't want to offend people on the show. But it's going to make you perky. It's not something that you're going to ease in and be like, all right, this is okay. It has to be like, wow, kind of a feeling. And 11 minutes a week should give you the effects you need to have your body give you all the positive benefits and reduce inflammation, all this stuff. I don't want to start telling people it's going to get into this quantum energy and stuff that everybody talks about. But legitimately, if you get into real medicine, it does have a lot of positive effects. Heat exposure, I've heard, does the same thing, 57 minutes a week of heat exposure. Ideally, I think it was like 320s, somewhere in that neighborhood. I don't know that because I don't have a sauna, but that is aligned with it. And so I've been researching this because it's interesting. You see people doing it. The day you come in, you hear me come in, and I start acting like a Russian. I just give you this this death stare, and I don't say anything. I'm doing too many ice baths. But if you look at, and I've just offended all the Russians. So if you, I love this. I'm gonna keep kind of mentioning on the show. I'm not gonna get into it too much, but it's been really beneficial for me in a lot of ways. There is some positive benefits for people who have depression and things like that. That has actually been studied a lot. I don't have that, but I've heard a lot of good health benefits come from that too. Anyway, I'm still loving it. I don't know what I'm going to do when it gets cold, but to your question, hopefully I'll be adapted by then, so it won't be as big of a deal. But it is an open question. I'm wondering. Anyway, moving on. All right, so this week we're going to talk about a bunch of stuff. A lot has happened in the last week. If you were sleeping and missed it, good for you. But in the last week, a lot has gone on, and I want to kind of dive into a little bit. So if you look back I'm just trying to pull up the chart here, see if I can get it without it taking over my screen. Let's see. Here we go. All right. So, sorry, I hate dead air. All right, here we go. So this is the S&P 500 in the last week and a half, let's say. Week and a half. So as you notice, pretty much the market has gone straight up. It did have a little hiccup here in April, and it's pretty much mostly gone straight up. But in the last 2 weeks, things have had a little hiccup. So the markets declined, they bounced around, and then of course we had a big drop. We had last Friday we had jobs numbers, which disappointed quite a bit. It wasn't a small disappointment; it was quite a big disappointment. I think it was like 150, 160,000 jobs. The expectation, I think it was like 115, somewhere in that neighborhood. So big difference. The Fed also said, and of course we had earnings last week, which came out, which were not great. A lot of the big tech companies got hit over the head, and so that impacted the performance of the index. Just big tech has a huge impact on the index in general, just because of the size of it. Now, that was part of it. And then, of course, the Fed came out and said they're going to lower rates, which Wall Street has been crying for them to lower rates for a long time. Yet, the stock market just keeps going up. So maybe it's not all that bad. I would argue that in normal times, if we had a normal economy, that a slowing economy is a bad thing. However, we live in Alice in Wonderland, which is bad is good, good is bad, or actually bad is good and good is good, and everyone has sunshine and rainbows every single day. So if you look at how the markets are designed now, it's actually pretty interesting. And this has been operating for a long time, not just right now. So for the past few years, we've had this new paradigm that I've been talking about. Now that inflation has subsided, and I do think that it is not coming back. I think if it comes back, I would be shocked. I've spent a lot of time thinking about this and digesting a lot of the data, and have realigned my thesis. So I wanted to share it first on the show. It's not fully aligned, but I wanted to share where my thinking is going. I've listened to some really good interviews with some people about this topic, and I've reassessed my thesis based on the data, and I've come up with this, is that we have this system which prints a lot of money, right? That's not a secret to anybody. They call it quantitative easing. I call it printing money. Where the Fed is printing money, no one benefits from them stopping printing money. So for those of you who think we should stop printing money, inflation's killing it, it's causing people to be poor, I'm 100% on board with you. So don't send me hate mail and say, that's blasphemy. They should keep printing money. Here's what I'm saying, is that they can't stop. We are past the point of no return. There is no choice. So we have a few choices. They can stop printing money, which will crash just about every single asset and every single company, because our whole system is based on leverage. So basically we have the apocalypse. That's one choice. Another choice is we keep printing money like we have been, and we try to drag out this problem as far as we can. People continue to get poorer. There's a bigger wealth disparity. The wealthy do fine, the poor do worse. All of that continues, but it happens slowly, right? Or they just make it a lot worse and just start giving free money out to people. And it's communism, socialism in the streets, which is obviously bad, which ends to hyperinflation and a lot of bad stuff. So we have three scenarios. All three are bad. Let's just say it. All three are bad. But the middle scenario is the best of, it's the best of the worst. So if you really think about it, what they're doing is the best that they can. And I'm not justifying their behavior. Be really clear. I don't like the way the Fed's handling this. I don't like the way the government's handling it. And I don't like the way that the system is built around feeding the beast and just, helping big corporations at the expense of everybody else. I don't like any of that. However, it's the system that we have, and all of us vote. And for everyone listening to this, including myself, we're the problem, because we're voting for these idiots that are running the show, and They're the ones causing the problem, and we voted for them. So inevitably, it's our fault, and we have to take ownership of that. If you don't, then you're not going to know where the problem lies. So if you think about the problem, what is the best scenario? Well, it's to continue the way they're doing it. And even though I don't like it, I don't control the Fed. I don't control the government. I barely even control my own family. So if you're really trying to do the best you can for yourself, you can complain about all the bad stuff, or you can look at the situation and say, this is a situation. How can I make the most of it? Let's start with that premise. We're all trying to make the best of the situation that exists, and complaining doesn't change anything. So what do? Here's the problem. We have an enormous amount of money printing. We have a stock market and asset prices that are largely dependent upon the Fed's balance sheet. Larger the Fed's balance sheet, the higher stock prices and real estate prices and asset price across the board go. That's basically the formula. I'm giving you the cheat sheet in a 10-second clip. Fed balance sheet dictates the growth of assets across the board. No, not all assets. If you look at commodities, they're generally not growing because technology is depressing the price of commodity prices. If you have oil gets expensive. They come out with some new technology and it lowers the cost of oil. Eventually, come up with nuclear. People aren't going to be as interested in oil. It's going to lower the cost of oil. So if you look at this, commodity prices generally aren't going to go up that much. They might spike, but they'll come back down to a reasonable range. But if you look at companies, you look at asset prices, they're going to continue to go higher as long as the Fed balance sheet continues to grow. And I don't see them shrinking that anytime soon. Maybe for short stints, but generally they're not going to do that. So what does that mean for you? If you're wondering why your value stocks are not going through the roof, if you're wondering why your bond prices are not going through the roof, if you're wondering why your conservative investments are not keeping up with the Magnificent Seven, here's the problem. The only assets that can outperform the Fed's balance sheet are technology and crypto. Everything else can grow. Maybe it keeps pace with inflation, maybe. But you're not going to get growth beyond that. The only thing that's going to do that is tech and crypto, which is why all these tech people are so into crypto. This is why all these deep thinkers out there in the financial world, they're not a lot of them. I don't call Larry Fink a deep thinker, but you've got some people out there a little more philosophical about macro investing, and they talk about some of these theories, and I've kind of wrapped my brain around, you know what? Yes, these things are more volatile, but if you really want to outperform, I don't see anything else that's outperforming at a grand scale, right? You could look at McDonald's, and McDonald's is great, or Walmart, or all these companies. Nothing against them. But if you look at the big picture, they're going to keep pace with inflation rather than exceed it. And we're all trying to outpace inflation with our buying power, or else what are you doing? So I bring this up as a new framework. I'm not saying that you have to buy only tech and crypto. That's not what I'm saying. And please don't do that and then write to me, oh, I lost a lot of money because I did what you said. I'm not saying that. So don't do it. What I'm saying is, if you think of the framework, what are the things that are going to outperform? Gold is not outperforming. It's doing great. It's going up. Silver's going up. Real estate's going up. All that's great. But is it going to outperform inflation? True inflation, not the CPI, but actually true inflation. I don't know. I mean, the S&P is basically keeping up with the Fed balance sheet, which means it's keeping up with the growth rate. And as they keep printing money and as they keep debasing our currency, you need to have something that's going to retain its value. Unfortunately, the S&P 500 is that thing. I'm not saying it's a great or terrible investment. I'm just saying it's marking it. If you kind of compare the two, which we'll put together some charts for next week. I just want to share this framework because it's basically swizzling my brain right now, and I'm rethinking the inflation framework of the 70s because I don't know if that's going to really happen because I just don't see the numbers lining up. I think it should happen. There's a lot of unknowns there, and there's a lot of confusion, as I've said, which did mark the 70s. But I'm not sure we're going to repeat the 70s in the way that I originally thought. Because we have different frameworks. We have a lot more leverage in the system, and the leverage in the system is not impacting the markets as it did then. And so Doug and I have been talking about real estate for the last 2 years and why real estate is not happening the way that we think it should happen. Now, I want all of you to take this as a lesson. Everyone can be wrong, and at some point is. And I've shared this before, I'm wrong sometimes. And I have not been able to put the piece together for the real estate puzzle. I just haven't been able to. I've been talking about it in the show. I haven't been able to square that circle. And it's been really confusing me. And my new thinking, my new framework takes into account real estate and why it's doing this is because it's this, there is no other alternative. If you're going to keep pace with inflation, if you're going to try to at least keep pace with the balance sheet and the cost of goods and services, you have to have exposure to these higher impact things that are not tied to inflation necessarily. Crypto is tied to technology, right? Technology growth, like the big tech, they're tied to the advancement of technology. AI is going to far outpace the growth of anything else. It's going to be volatile. It's going to be a mess. There's a lot of problems there. But for people that are hyper growth, they're like, yeah, I've always thought that. I want growth at any cost. Yeah, but there's a lot of value investors out there, and I'm one of them, right? I'm a value investor. I think of things in terms of value. What is a good value to buy? I'm not going to buy something because it's going up, which is, in my opinion, stupid. But there are people who make lots of money in it, so it's not stupid. It's just a different kind of investing. I look at things and say, all right, if I can buy $3 for $1, that to me is a good deal. Somebody might buy $3 and say, yeah, but it's going to go up to $6. I don't like that framework because to me, that doesn't make financial sense. I like to look at things logically. So my point this week is we're going to election season where I'm going to raise this frame and I'm not supporting any politician, but I know Kamala has completely changed her point of view on a lot of issues. I actually don't mind that. I think people should have a right to change their view. I'm not supporting her. I'm not against her. I'm just saying she's come out and had completely contradictory views now than she had before when she was VP. I actually don't care, right? You think about Trump. Trump was a Democrat. Now he's a Republican. So what? You have a right to change your mind. Now, we are human beings and we have a big ego, and we don't want to change our mind because we've kind of dug in our feet that we have a perspective. And that perspective, it has to always be the same or we're going to look like idiots. You won't look like an idiot. You look like a smart person because you came up with new information and you changed your mind with that new information. There's a good meme that always goes around, and they attribute it to one of the economists. I forget who it was, but it's like, when I get new information, I change my mind. What do you do, sir? And I always love that meme because it's so true, right? But we all get stuck in this is right, my opinion's always right. And it's like, well, what if the facts change? What if the frameworks change? What if the economy changes? Are you going to be stuck in the old way saying, I still think buggy whips are the best investment ever? Like, that's just stupid thinking. So we all do it. It's human nature. I'm not calling everybody stupid, including myself. I'm saying it's human nature. It's how we're built. What I'm saying is you need to be smarter than that. As an investing framework, we're all wrong. The best investors and traders I know are quickly able to adapt to them being wrong. They say, oh my God, I'm wrong. Let me do the exact opposite. That's really hard to do, right? If you think crypto's the best thing, you find new information, you're like, oh my God, crypto's going to zero. And then you short it. That's hard to do, right? Because not only were you thinking one way, but you've gone the other way. It's like you're a flip-flopper. We're the home of John Kerry, the flip-flopper. Like, he's very well known for that around here. But that's more political. But what I'm saying is you need to be agile in your thinking. You need to be able to adapt to new conditions and say, because, like I said, I've always been wrong on real estate. I've said this. I'm like, I can't understand it. Now I have a framework that encompasses. I'm like, I think this is more aligned. Now I'm still thinking about this. I'm still going through the framework. So I know I get a lot of emails about this. Feel free to send your emails. but I'm going to be answering a lot of this on the show in the subsequent weeks because I'm putting more thought into the framework to make sure that this framework's correct. But I did want to tip my hand a little bit because I feel comfortable enough with the new framework to say now things are starting to make sense why the markets keep going up. Now, I'm still a little skittish going to the election, not because of politics, but because of the uncertainty of a lot of things, as well as the fact that the markets are way overvalued and we're going into the weakest part of the year, pretty much from mid July until August. I'm sorry, mid July until early November is the weakest part of the year historically. So, not a great if you had to pick a time to be in the year, now is not the best time. So, if the market's going to be weak, now is the time to do that. The market has been ahead of statistical numbers all year up until a few weeks ago. So now I could see the market softening and it would be totally normal. So just keep that in mind. And I want to give it to Doug because I'm monopolizing the mic, but I did want to kind of share that with everybody because it's a new framework. It does align. And I think that people need to understand that it's okay to change your mind. You know, as long as you're on the right track, adapting is a good thing. What are your thoughts, Doug? Am I an idiot? Or, well, maybe I shouldn't ask you that. Yes, the answer is definitely.
So I have nothing more to say then. Listen, I think one of the things that is significantly different between the 70s, and you're right, we've talked ad nauseum about what inflation was in the 70s, how we saw some potential similarities. A couple of things that that are happening that are different than what happened. Number one, we don't have the oil embargo. Okay. That was tremendously impactful to the United States. I mean, you go back, look at the pictures, cars being stuck in lines for hours as gas stations were running out of oil. You know, you talked about nuclear. We still run heavily off of petroleum today as we did then, although there have been some adjustments, changes. We're going greener. I mean, I don't think the impact of an oil embargo would necessarily be the same as it was then, although it would be extremely painful. And when if you drive up the oil at the level it did then, when there was an oil embargo and everything that we produce, which again, at the time, also keep this in mind, the United States was still producing a tremendous amount of goods on our U.S. soil in the 70s. Ask anybody in the Rust Belt, right? And look at all the cities that are that collapsed from the fall of the auto industry that started kind of late 60s into, well into the late 80s. Everything we made, if we can't get oil and there's an embargo, drives up everything. So inflation was somewhat tied to the fact that oil went through the roof. Now let's look at the other scenario, which is different. I mean, you can say what you want about Powell, and you can say that you completely agree with him. You can say that he's the worst, Fed chair ever, right? I would say that as you mentioned, he's done. I think he's personally done a decent job given what he had to deal with COVID and coming out of some of the policy decisions of some of his predecessors. But if we come back and take a look at what was going on in the 70s, and we've talked about this, before, is that one of the biggest problems that was going on in the 70s was stagflation. And we are facing some of that, although it is easing as of now. Is that, first of all, we have other things here, like you talked about AI, which are allowing ways in which even when we're starting to see suppression in certain areas like commercial real estate, there are areas that are still in wide expansion. Now, normally in economic cycles, you start to see a significant decline in a number of different areas. And we joked about this before. Kobesi Letter said this. It's like, this thing's going up, this thing's going sideways, this thing's going down. There's no consensus in a number of different asset classes that indicate that we are in a recession or that we're in an expansion, right? And because of that, it makes it hard to pinpoint what a recession or an expansion is in terms of status of where we are today, okay? Because we don't have that full pullback. There are definitely data points that say we're in a recession, but there's other data points. I mean, okay, the stock market was volatile in the last, and certainly fell hard in the last week or so. But that's after what kind of a run since last October? I mean, you're still well ahead. So in that regard, everybody's wealth significantly expanded overall since last October. So again, people have more money, people have more wealth. They're going to be able to continue to drive demand. That's going to drive, up supply. So the fact that we right now don't have prices expanding at the level at an extreme level, as a matter of fact, that again, they're still going up. This is what people understand. Inflation is when inflation's down, it doesn't mean it reversed. It just means it's not going up as fast. If we pull that back, the fact, to be honest, the way the markets went since last October. Now, most of that is, of course, in people's 401ks. They can't touch. But you're still looking at the wealth of the incredible wealth of a lot of people that do have non-qualified or non-IRA assets that were in the markets that blew up since last October. And if that is the case, that's a lot more wealth that they have to spend, which means that spending demand on the economy could still be strong there. It actually surprises and counters the fact that even though the rest of M2 supplies pull back, that inflation has actually not continued to stay as high as it could have, considering that even though interest rates were high, the market was still on a tear. Now you go back to the 70s, though, and you go back to that Fed policy. Remember, we've talked about this, the reversal, the back, the forth, raise rates, lower rates, raise rates, lower rates. That's why it's extremely concerning if the Fed gets skittish and tries to chase what's going on. And Powell came out recently and said, I don't care what's going on in the markets. That's not how I make decisions. That is actually, in my opinion, a very mature stance to take, because what you run into is going back to the decisions made in the 70s, is too much listening to the noise going around instead of sticking to a goal of, trying to achieve a certain outcome. Unfortunately, they were listening to the noise, and as they listened to the noise, it made them reverse their stance instead of staying committed. And that's when you all of a sudden ran into the stagflation issues until Volcker came along and really just said, we're going to go through the pain and suck this out. Powell has wanted to be more Volcker, okay? And to a degree he has. Now, maybe he pulls rates back again. They've said, again, the predictions of rate cuts have gone up again. Guess what, Kirk? Look how many people thought there was rate cuts 8 months. There were going to be eight rate cuts going into this year. It didn't happen. So sometimes, and I'd say a lot of times, the opinions and predictions of those rate cuts are, again, they are pushed out there by people that A, don't have a clue, and B, are maybe more optimistic than necessary. Maybe it'll happen. But at least Powell has said, I'm going to do this because I feel that the metrics that we are trying to achieve have warranted this. Has he capitulated a little bit at times? Like, are you sticking to your agenda? Maybe a bit, but for the most part, he's remained very firm, and he's also followed through with what he was going to say. And because of that, things are happening exactly the way as we kind of expected to a degree. The interest rates have stayed up. We are feeling the softening in certain areas. And from there, if he does decide to, the Fed does decide to lower those rates, it's going to be because of more than just, assets declining. One last thing I wanted to say that I thought was interesting. You mentioned about the S&P 500 just keeping up with inflation. Now, first of all, you talked about tech and crypto, Bitcoin, et cetera. Again, a lot of the S&P 500 has been driven by tech. So if you are just investing in the S&P 500, and if tech gets hot, well, let's face it, a lot of the S&P 500 performance will then likely be based on how tech's doing anyway. So there is, again, that balance of the way the value of the S&P 500 actually is calculated. You do get a little bit of that crossover there from those concentrated asset classes. But the other thing is, if we go back years and go in financial planning, we used to actually correlate that cash was basically paid inflation. And if you look at the 80s when cash was paying 15, 18% at times, and you look at what inflation was, you go, okay, that was the correlation. What I find very interesting now in your comment, Kirk, is that you're saying that the S&P 500 or that the stock market or value investing is now just keeping pace with inflation. If so, and if this data is in line to be true, then that is a significant shift over the last 30 years. It's something to note, because cash used to keep up with inflation and the markets used to beat inflation. Now, if cash is way below inflation, which we know to be the case. The banks haven't paid anything. And now you have to be in the S&P 500 to keep up with inflation and go into other assets to beat inflation. That is a significant impact on planning. It's a significant impact on methodology. It's a significant statement to what inflation does over time to the ability for people to keep up with those rising costs.
Yeah, and I think the challenge that we all have, and I'm gonna try to share this. It's funny because I was just on spurious correlations again, and from last week, and it's funny. I actually found the popularity of "Change My Mind" meme, which is the one I was just telling you about, and the correlates to the number of pipe layers in West Virginia. So just just know, pipe layers in West Virginia are also talking about this meme. Anyway. Point being, so here's a takeaway. Okay. I'm not giving you investment advice for anything I'm saying today. What I'm trying to deliver is a new framework. It's actually not a new framework. It's a framework which I was misaligned with, because when you have actual high inflation like we had a few years ago with the CPI hitting like 9%, that's dangerous territory. It's not, oh my God, we have hyperinflation territory, but it's definitely higher than it would lead to a good economy. Now, the fact that the Fed raised rates, the fact that the Fed, I mean, you mentioned about Powell, everyone knocks on Powell and everyone knocks on the Fed. I'm not a fan of the Fed. I'm not a fan of any of the governors, and in none of the Greenspan, Powell, Yellen, Bernanke. I'm not a fan of any of them. But I do think that they're doing the best thing that they can given the situation that they're in. And I think here's the question I always ask is, when people say, oh, Powell's doing a bad job. Okay, what would you do different? Because there's an element to this that and this is where I'm going with this. We all want to have an enemy. We all want to fight the enemy and throw rocks at them. But the reality is, let's say you installed yourself as Fed governor today. What would you do different? And here's the answer. You wouldn't do anything different, because if you fully thought it through, here's what you'd realize is that any of the things you think you do would lead to unintended consequences, which would be massively terrible for the US, for the global economy. And we're already going off, we're already going off the train tracks. We're heading down the train tracks and there's an end, and we're going full speed at it. It's not going to change. You can't stop the train and go in reverse. It's going forward. So what do? Right? Do you go left? Do you go right? You just keep going. What the Fed and what the government's decided to do is we're just going to keep going. We're going to keep going this path because there is no other alternative. And that's the problem, is that it sounds good and feels good to throw rocks at people and say, yeah, the Fed's doing a bad job and we need to do something different. You can't. Because I always put myself in this position. What if I was the Fed? What would I do? And I come back to the same answer. I don't know. I don't know what I would do different. I know what I would want to have done with the economy. You're not printing money. You're not causing inflation. You're not doing this. That's all well and good, but that's not where we are. Now, if it was 100 years ago, I'd say, yes, you have a good path to manage. Here's what we should do for the next 100 years. But we're not going back in a time machine to change that. Today, we're looking at an economy that's over-leveraged in debt, household level, corporate level, governmental level. Everyone's got way too much debt. What do? You can't do anything. You can say, well, I'm not going to print more money. Okay, our whole economy is based on leverage. And mind you, our whole economy is based on basically assets, right? So if you borrow for a house, your house is the asset that backs the mortgage. What if your house value goes down? Now you're underwater. Now you have no equity. So what do? Well, you just give your keys back to the bank. Hey, see you later. I'm done. Right? What if it's a company, right? You have a company, it has cash flow, and you take out a bunch of debt. And then all of a sudden, the asset price goes from $100 down to $10. Well, now you can't use your shares to borrow. You can't issue shares to employees because they're not going to want them because they're deeply depressed. Or if they have stock options, they're not worth anything anymore. Our whole system is based on asset prices going up. So if they don't go up, our whole system implodes. That is the problem. Now, if we were 100 years ago where we didn't have leverage in the system, where it wasn't, people own their homes outright, they didn't have these huge mortgages, these 80/20s, you could pay off your mortgage in a few years. All of those things were different. You could do things differently then. We are not in that world. Everyone has too much debt. Personally, you have a house, you have 80/20 on your house. That's too much debt. We could say, yeah, well, it's whatever. That real estate's going to go up and eventually it'll pay itself down. 100% agree. I'm not debating that. But what if your house doesn't go up? In Japan, back in 1990, Japan went for 35 years of deflation. 35 years. Your house price went down for 35 years. Do you want to move? Not really. What about your mortgage? Well, you're already underwater. I mean, the whole system doesn't work. It only doesn't work. It actually implodes, where all asset prices drop significantly because it's all based on debt. So if you look at, I'll give you an example. I'm not saying these numbers are accurate, but let's say you've got a household. You've got 100,000 in assets, and you got 50,000 in debt. If you collapse them, let's say you sold everything, you had a pile of cash, you'd have $50,000, right? That's your equity, right? That's your net worth. It's $50,000. Now, let's say you had an asset of 100,000, you had $200,000 of debt, and you sold everything. Well, now you still owe 100,000. So what do? Default. You don't have any assets, right? You stop paying it. That's the problem with the system. We have a system where the government has way more debt than it can ever pay off. It has debt that is costing a third, like it's maybe not a third yet, but it will be shortly. 20 to 30% of the government expenditures are going to pay down the debt, the interest on the debt. We're never going to pay off the debt. So if you have that in your head, you're lying to yourself. I know people want to tax the rich. You can't tax the rich enough. You can take all their money. It's like a speck. All you're really doing is saying, I hate the rich. You're not actually solving any problems. That's one of the problems that the left has, is that they want to tax the rich. Taxing the rich actually doesn't solve any problems. If you really run the numbers, you realize how stupid that philosophy is. Doesn't mean you still don't want to do it, right? Let them eat cake. We're going to go, basically behead everybody because we don't like them because they got too much money. Well, if that's your philosophy, you probably shouldn't be listening to the show. But if you're a rational person who's looking at the numbers and saying, well, actually, that doesn't work, what does work? Well, there are many things that can work, and that's not the point of this show today, but that's not one of them. Like, the numbers don't add up in that way. So if you're trying to look at the big picture, right, what can we do? At the moment, the only thing you can do is technology will outpace inflation. It will outpace just about any of the problems that we have, but it will be a volatile ride. It'll be rocky. It's not going to be a straight shot. AI is going to have problems. It's also going to hit us a lot quicker than we realize, and it's going to destroy the fabric of society as we knew it 20 years ago, right? Things are going to be different, and I don't think we're all prepared for the impact of AI. I don't think so, because when we hit the singularity, and I don't have time to explain that, but when we hit the singularity, nobody can predict what happens after that. Could be good, could be bad. We don't know. And so we're headed for that. We can't stop that train. So what do? I don't know. Do you get out like the Luddites and destroy all the computers? Well, good luck with that. I mean, you can't stop it. All you have to do is be prepared. So the point of where I'm going with this today is I'm trying to prepare you all mentally for where things are going on a mid to longer term perspective. I'm not saying go sell all your stocks. I'm not saying go buy all the stocks. Like, today is a different time frame than 5 to 10 years from now. What I'm talking about is in the next 3 to 10 years, this is kind of what I'm talking about, is you need to be thinking in this time horizon, how are you going to react to this so that you don't get bulldozed by all these effects? Because they are going to impact all of us. It's just a function of how it impacts you. So Doug, I know we got 2 minutes. We're going to wrap it up. We got some stuff we'll go into next week. But I did want to point out one more thing before we wrap it up, and that was to share really quickly Japan, because Japan had actually a big impact, and I'm not going to get into this topic this week, but maybe next week. The carry trade in Japan was a huge impact on this. Here's actually the Japanese yen. Here's a stock chart of that. And here's an index of the Nikkei 225. So this is what happened in the last few weeks. It went from above 4,200 down to a low of...
Kirk, are you sharing or no?
Oh, you're not seeing it? Oh,
nope.
Sorry. Okay. Sorry. Real quick before we wrap it up. So here's the yen. Advertisements. So here's the yen. If you were doing a carry trade, which we'll explain next week, this was not good. If you're on the other side of it, here is the index, the Nikkei, and it went from basically 42.5 down to basically 30,500. That's a huge drop, right? In the Japanese stock market. A lot of it had to do with the carry trade. A lot of it had to do with the U.S. There's a lot of reasons that it happened. But if you were invested in Japan, then you had a bad day or a bad week. So point being is that the stock market was generally pretty complacent up until mid-July. And now we've all gotten a little bit of a wake-up call, and people are reassessing where they want to put their money because things are not necessarily as they would have expected. And now we've got some potential problems ahead of us, and we need to figure out, is the stock market going to keep going up or not? And, there's a lot of volatility that's been injected back in the system. That is a good thing. Some people hate it when the markets go down. It's a good thing because it normalizes what's going on. So we'll talk more about this next week, but I did want to just talk about it a little bit because it did happen. The markets are kind of stable at the moment. It doesn't mean they'll stay that way, but at the moment they are. So Doug, take us home here.
Yeah, Kirk, appreciate it. So I did want to say, I know you don't like to offend people, but I just want to clarify, you have no problem offending people who believe in the extremes of eliminating all taxes or just taxing the rich. Clearly, that's not a problem. Who we want to offend here? If you did on common sense financial advice, it's probably the wrong place to be, and maybe there'll be some offense, something to offend you. Listen, I know we're wrapping it up here. One of the things I also, want to we can talk about too in the upcoming weeks is starting to see some proposals. I know coming in the election season about what the outlook of could be for taxes, especially going into 2025. I've got some notes on that we can talk about in one of our upcoming conversations. I thought was a really interesting review of some of what Biden had proposed versus what Harris is talking about, what Trump's talking about. A good comparison. But hey, I also got someone reached out to me this past week, wants to talk college planning. So thank you for if you're one of the listeners that I'm going to be talking to soon, because I know this is on people's minds, right? You're talking about where do I make money and beat inflation? Well, listen, don't give it away. It's the first part. It's the first part of being able to be wealthy. I like how you talked about the house, Kirk, because when it comes down to it, there's one of the things that a lot of people do to pay for college is to go in debt. And a lot of people, you hear from people out there like Dave Ramsey and other people are like, hey, you never want debt of any kind. But this is something that gets confusing to a lot of people because there is times to use debt. There's times not to use debt. People like Elon Musk use debt. Billionaires use debt all the time. Business people use debt in the right way. If you're in debt, it means that you have bought something you can't afford. Pure and simple. And the only way you're going to pay off using somebody else's money is future income yet to be earned. Okay. And let's hope you earn it. Otherwise, you're going to become a slave to the lender. This is how a lot of people go into college. They try to take on a cost they can't afford, and then they just take on the student loans that they can never get out of. And if you want to go find a little bit more about that, go and take a look at the debt clock and how much debt there is out there just for college. Okay. On the other hand, you talked about a house, Kirk. A house is an asset. And I like what you mentioned there, that if you wanted to get, if something comes a problem, you can sell the house or walk away as long as you've got equity and you're ahead. That is debt, but it's not being in debt because you've got multiple ways to pay it. You can pay your mortgage off over time. You can sell your house, get rid of it. You can also, do other ways in which you can cover that. So as long as you're ahead. And that's what I'm going to say about college. There are ways to go into college that can really, really save you financially. Can help you with your retirement. Make sure that you're not overspending. Get the cost down. Don't not in a situation where you have to take debt that you can't afford. There's a lot of different strategies to pay for college that you'd be surprised where we can find money you might be losing unknowingly or unnecessarily and make it more affordable and take that stress away, as well as the process of the right schools. If you want to hear more about that, Mergent College Advisors, that's our company. Love to hear from you. Talk about how you can protect your retirement and maybe even increase your wealth through the benefits of proper college planning. The Journal of College of Financial Planning, Money Magazine, they're all talking about how critical this is. And most people out there, when they do financial planning, they're not looking at college and they're not looking at housing, which, would you agree, are two of the biggest financial costs you'll ever have. So if you don't have those in your financial plan, you probably don't have as comprehensive as you think you do. Come talk to us.
Great. Well, Doug, I appreciate you coming on the show as always. And that's the show for this week. Thank you again for joining us, Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast in the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On the website, you'll have access to the show notes, resources, and the archive shows. Also, we're now on YouTube. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, please leave a show rating and comment on the podcast app of your choice. Oh, and don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send me an email to express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one. As I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest